How to trade stocks. Welcome to Be a Baby Billionaire. Navigating the intricacies of the stock market requires a solid understanding of its fundamental principles, trading strategies, risk management techniques, and the broader economic landscape. From deciphering market psychology to analyzing economic indicators and implementing effective risk assessment strategies, mastering the art of stock trading is a dynamic and continuous journey. In this comprehensive guide, we delve into the essentials of stock market dynamics, exploring topics ranging from the fundamentals of the market and types of stocks to advanced trading strategies and risk management principles. Whether you're a novice investor looking to embark on your trading journey or an experienced trader seeking to refine your skills, this guide offers valuable insights and practical advice to help you navigate the complexities of the stock market with confidence and proficiency. With a commitment to continuous learning and a thorough understanding of key market concepts, you can unlock the potential for long-term success and financial prosperity in the ever-evolving world of investing. Understanding the stock market. The stock market is a dynamic marketplace where investors can buy and sell ownership stakes in publicly traded companies. Key players in the stock market include individual investors, institutional investors such as mutual funds and pension funds. Exchanges like the New York Stock Exchange and Nasdaq serve as platforms where stocks are bought and sold. Terminology in the stock market encompasses various concepts such as stocks representing ownership in a company, indices measuring the performance of a group of stocks, and order types like market orders executed immediately at the current market price and limit orders. Understanding these basics is essential for navigating the complexities of the stock market and making informed investment decisions. Types of stocks. Stocks come in various types, each with its own set of characteristics and risks. Common stocks represent ownership in a company and typically offer voting rights at shareholder meetings, as well as the potential for dividends and capital appreciation. Preferred stocks also convey ownership, but often lack voting rights. However, they usually come with fixed dividend payments and precedence over common stockholders in receiving dividends and assets in case of liquidation. On the other hand, penny stocks are low-price stocks, usually trading below $5 per share and often found on over-the-counter markets rather than major exchanges. While they may seem appealing due to their low price, penny stocks are associated with higher risk due to their volatility, lack of liquidity, and higher susceptibility to manipulation. Understanding the characteristics of each type of stock is crucial for investors to make informed decisions aligned with their risk tolerance and investment goals. Brokerage accounts. Brokerage accounts are essential tools for individuals seeking to invest in the stock market. These accounts serve as intermediaries between investors and the market, allowing them to buy and sell stocks, bonds, mutual funds, and other securities. Opening a brokerage account typically involves selecting between full-service brokers who offer personalized advice and research but often charge higher fees, and discount brokers who provide self-directed platforms for trading at lower costs. Once opened, managing a brokerage account entails depositing funds, researching potential investments, placing buy and sell orders, and monitoring the performance of the portfolio. Brokerage accounts offer investors flexibility, convenience, and access to a wide range of investment opportunities, making them indispensable tools for anyone looking to participate in the financial market. Fundamental analysis. Fundamental analysis is a cornerstone of investment decision-making, focusing on evaluating a company's financial health and prospects to determine its intrinsic value. This analysis involves scrutinizing various aspects of a company's operations, including its earnings, revenue, expenses, assets, liabilities, and management team. Investors delve into financial statements such as the income statement, balance sheet, and cash flow statement to assess these metrics and understand the company's performance. By comparing a company's fundamentals to its stock price, investors can gauge whether the stock is undervalued, overvalued, or fairly priced, helping them make informed decisions about buying, selling, or holding a stock in their portfolio. Technical analysis. Technical analysis is a method of evaluating securities by analyzing statistical trends gathered from trading activity, such as price movement and trading volume. It involves the use of various charts, patterns, and indicators to identify potential trading opportunities. Technical analysts believe that historical price data can provide insight into future price movements, enabling them to make informed trading decisions. Charts display price data over time, allowing analysts to identify trends, support and resistance levels, and chart patterns such as head and shoulders or triangles. Indicators such as moving averages, relative strength index, RSI, and MACD, moving average convergence divergence, help traders gauge the strength and momentum of price movements. By combining these tools, technical analysts aim to predict future price movements and capitalize on short-term trading opportunities in the market. Risk management. Risk management is a crucial aspect of successful trading and investing, aimed at minimizing potential losses while maximizing returns. Diversification involves spreading investments across different asset classes, industries, and geographic regions to reduce exposure to any single risk. Stop-loss orders allow investors to set predetermined price levels at which they are willing to sell a security to limit losses. Position sizing involves determining the appropriate amount of capital to allocate to each investment based on risk tolerance and the potential for returns. By implementing these risk management strategies, investors can protect their capital from significant losses and maintain a balanced portfolio that withstands market volatility and unforeseen events. Trading strategies. Trading strategies encompass a variety of approaches that traders and investors employ to capitalize on opportunities in the financial markets. Day trading involves buying and selling securities within the same trading day to profit from short-term price fluctuations, often relying on technical analysis and leverage. Swing trading focuses on capturing short to medium-term price movements by holding positions for several days to weeks, based on technical indicators and chart patterns. Value investing seeks to identify undervalued stocks trading below their intrinsic value, typically through fundamental analysis, with a long-term perspective on potential appreciation. Growth investing targets companies expected to experience above-average growth rates in earnings, revenue, or other metrics, often focusing on innovative industries or disruptive technologies. Momentum trading exploits trends in stock prices, aiming to ride the upward or downward momentum generated by significant price movements. Each strategy has its own risk-reward profile, time horizon, and suitability for different market conditions, requiring careful consideration and adaptation to individual preferences and objectives. Market orders versus limit orders. Market orders and limit orders are two common types of orders used to execute trades in the financial markets, each serving different purposes and offering distinct advantages. A market order is an instruction to buy or sell a security at the best available price in the market at the time the order is placed, ensuring immediate execution, but providing no control over the exact price at which the trade will be executed. In contrast, a limit order allows traders to specify a price at which they are willing to buy or sell a security, providing more control over the execution price, but no guarantee of execution if the market does not reach the specified price. Market orders are typically used when immediacy is prioritized over price. Market psychology. Market psychology encompasses the collective emotions. Emotions such as fear, greed, and optimism can drive market sentiment, leading to fluctuations in stock prices that may not always align with a company's fundamentals. Investor behavior, influenced by psychological biases such as confirmation bias or herd mentality. Understanding market psychology is crucial for investors to navigate market volatility, anticipate potential market trends, and make informed investment decisions. By recognizing the impact of emotions and investor behavior on stock prices, investors can develop strategies to mitigate risks, maintain discipline during periods of market turbulence, and capitalize on opportunities that arise from market inefficiencies. Economic indicators. Economic indicators are key metrics used to gauge the overall health and performance of an economy, influencing stock market movements and individual stocks. Gross domestic product, GDP, measures the total value of goods and services produced within a country, serving as a primary indicator of economic growth. Positive GDP growth often correlates with bullish stock market sentiment, indicating increased corporate profits and consumer spending. Unemployment rate reflects the percentage of people actively seeking employment. Inflation measures the rate at which prices for goods and services rise over time, impacting interest rates and purchasing power. Moderate inflation can stimulate economic activity, but high inflation can erode purchasing power and lead to uncertainty in the stock market. Understanding the implications of these economic indicators enables investors to assess market conditions, identify trends, and adjust investment strategies accordingly to optimize returns and manage risks effectively. Risk assessment. Risk assessment involves evaluating the potential risks and rewards associated with investment opportunities, considering various factors such as volatility, liquidity, and company stability. Volatility measures the degree of price fluctuations of a security over time, with higher volatility indicating greater potential for price swings and increased risk. Liquidity refers to the ease with which a security can be bought or sold in the market without significantly affecting its price, with more liquid assets typically offering lower transaction costs and reduced risk of price manipulation. Company stability encompasses factors such as financial health, industry dynamics, and management competence, which impact the likelihood of sustainable growth and profitability. Paper trading. Paper trading, also known as virtual trading or simulated trading, is a practice where individuals can simulate real trading scenarios without using actual money. It involves using virtual funds to execute trades based on real-time market data and conditions, allowing investors to gain valuable experience and test various trading strategies in a risk-free environment. By participating in paper trading, individuals can familiarize themselves with the mechanics of trading platforms and assess the effectiveness of different investment approaches without incurring financial losses. This simulation enables investors to refine their decision-making processes, understand market dynamics, and build confidence before transitioning to real trading with real capital. Continuous learning. Continuous learning is essential for success in the stock market, as it is a dynamic and ever-changing environment. Recognizing that market conditions, regulations, and economic factors evolve over time, investors must commit to ongoing education and staying informed. This involves reading books, taking courses, attending seminars, and staying updated on financial news and market trends. By continuously expanding their knowledge base, investors can adapt to new developments, understand emerging opportunities, and navigate challenges effectively. Summing up, mastering the art of stock trading requires a blend of knowledge, strategy, and adaptability in navigating the complexities of the financial markets. By understanding fundamental principles, trading strategies, and risk management techniques, investors can make informed decisions aligned with their financial goals and risk tolerance. Whether you're a novice investor embarking on your trading journey or an experienced trader refining your skills, continuous learning and a thorough understanding of market dynamics are crucial. Time for the soft question. What incentive do you have to trade in stocks, and what are your reasons to do so? Please share your thoughts in the comment section below. This will help everyone learn and grow together. Subscribe with us and learn. If you find the information in this video valuable, please subscribe and share it with family and friends. Your support will help us create many more high-quality videos like this. Please support us. Please hit the like button and the notification bell to be notified. Click on these 2 videos shown here to explore even more. The contents of this video are for educational and informational purposes only. Thank you for watching.